Centaur Flexible Fund has returned a compound return of over 18% per annum since its inception, which is now just over 7 years ago. To flesh out their investment philosophy and take a look at RMI, Richemont and Discovery, we're joined in studio by Roger Williams, Chief Investment Officer at Centaur Asset Management, and I thought I had just said all that. So Roger, thanks very much for joining us, and that double introduction, it means you're doubly important. Looking at your performance, incredible performance since inception, your investment philosophy, and this is where I chat to a number of players in the industry, and you drill down into investment philosophy, and pretty much all seems to converge in the same area. It's all about focus, about high conviction, about moats, etc., etc. Does your strategy differ at all?
Listen, I think there's a lot of similarities, but I think you really have to keep it simple and focus on what you're good at. And I really look at relatively good value but good prospects. So you want the combination of the two. When there's good prospects but it's not discounted into the share price and the share is relatively good value, that's when an opportunity arises. And you have to exploit it and be quite aggressive. So you almost have to wait and then pounce when the opportunity arises. So an example, I've liked Richemont for a couple of years, and I never thought the price was quite good enough. It didn't satisfy that criteria. And last year, with the European crisis, it came down quite dramatically. And their business hadn't been slowing down. It was more perception, European crisis, and it got below 37 Rand, which was an exceptional valuation. I think it was a good opportunity, and you can see now that it's jumped to 50. So that's an example. You wait for a good company to be in a dip, on a bad spot, climb on board and really ride the recovery.
Well, I just have to point out, I was looking at your street cred there, and a professional blackjack player at the age of 21. I think I would back Roger any day. That's what you need. That's the kind of background you need to play in this industry. Don't you agree, Paul?
Well, look, this is not a gambling industry, so let's not confuse that.
But, oh no, it's not a gambling industry by any means.
It's risk versus reward.
Just in terms of Richemont, obviously you must be smiling, given that the stock rallied significantly of late after their results are up 7.5%, I think, on the day that they released their results. Can they sustain that momentum?
Listen, I think they grew the top line at almost 30% last year, which for a very large business obviously can't be sustained indefinitely, but the core drivers are very, very positive. There's very strong demand for their product from the Far East. The Far East is over 40% of their revenue now. And even the US and Europe has been relatively strong.
Because of Chinese tourists in those territories.
Yeah. And I think there's going to be good demand over the next 5 to 10 years. People, they just want luxury. Actually, it's almost a minimalistic trend. They want good quality. So it's like Apple. They just want that product. They want good watches, good jewelry, and I think it's going to continue.
Roger, you've made a very good call on your resources. I see your benchmark is 15% in resources.
Yes.
And you've been underweight in a very difficult patch or period. I think the resource index is down 20% since its high in February.
Yes.
What are your feelings now on that sector?
I'm still a bit wary. I think there's a lot of pressure on resources, particularly from governments wanting a bigger slice of the pie. And it's not just, in third world kind of countries. It's also Australia raised the taxes substantially.
Oh, but that's third world, isn't it?
Sorry. And then you've also got pressure on their margins. The resources aren't going up anymore, but their costs are. So there's actually a squeeze on margins. And even though the volume should come through, I don't think the profits are really going to be that strong, really because of those two pressures. And also they're very, very volatile businesses intrinsically. And I really can't get excited about them, even though they've underperformed dramatically. I'd rather go for something that's more certain. And on a global basis, I think there's also better opportunities.
Let's touch on RMI, because it's a stock that you have backed for a long time now, and it's done very well for you. Has it got more to come?
Yeah, I think I bought it at a very good level, or probably about 12.50 is my average entry price. So it's kind of moved up more closer to a fair value, and they really have to produce the goods now. But I think it's a company that will, the three components are Discovery, which is a stalwart growth company, and I think it's going to continue, and it keeps creating blue sky to grow. Then the other one's Outsurance, which is really a massive cash cow. Their margins and their profitability and their cash flow is unbelievable in South Africa. But they've started up in Australia, which is loss-making, but apparently their new business growth is already overtaking South Africa. So that's one for the future, and as that turns around, it's going to manifest in growth. And the other component's MMI, which is really maybe kind of a slower grower, but I think growth will come through really from cost-cutting over the next couple of years. So I still think it can perform, but that initial...
But it is close to fair value now. You say you do have to see the performance coming through.
The growth will more come through as the earnings unwind, and it's got about a 5% yield. So the combination of those two can give a return. I'm looking for around 20% per annum, which I think in this environment, there's not many companies which are bettering that.
No, I don't think so, because it's a low yield environment, isn't it?
In some cases, but not in all. And you obviously prefer that. It's your favourite share in the insurance sector.
Yes. I love Outsurance as a business. They get paid up front. If you look at their cash flow statement, their cash conversion is very good.
Do you use their products personally?
Yeah,
I do.
One of their first clients, and I think that it's brilliant. It's very, very simple. I've had claims settled very quickly. And they give something back to you, keep it simple, and I think it works. I think people have responded well.
Paul,
to
do you use a direct insurer? I'm just doing a little survey on the desk.
No, I don't. I use what used to be called Glenrand, now Aon.
All right. Well, there we go. 2 to 1 in terms of Outsurance.
Yeah.
Discovery. Now, what about pure or direct play into Discovery rather than through RMI?
Well, they've
Is there
actually
merit there?
got both, but it's Discovery is about 30% of the RMI valuation. Discovery also, it's got a lot of different revenue streams, great marketing, and very sticky products, and very growth orientated. And
trading at just under 50 Rand at the moment.
Yeah, also this one will come through as the growth unwinds. I wouldn't say it's cheap, but I think it will probably give you around 15 to 20% per annum in the medium term without too much business risk.
Paul, what are your thoughts on Discovery as a pure play?
Discovery. Oh, look, he was talking about sticky something and
products. Sticky products.
Sticky management too. Wow, they've stuck around. They hung in there. There's very little changes in that, and I see they're sending their top guy in Vitality to the US, I think to New York, to go and run the US operation. That was announced yesterday, I think, which is very interesting because they've lost, I think, $1.5 billion in the US, but now they're gaining some traction and they're turning around in the US, which is very good to see.
Do you like that move, a foray back into the US?
Yeah, they're keeping it small. I mean, they got burnt pretty badly. Often when you move overseas, you have to pay very big school fees, and I think...
And a number of South African companies have paid very big school fees in the US, haven't they?
And not ventured back.
But it's, it's like things in life. Sometimes you have to get experience, and then, second time you're much wiser, and I think that's... It was painful, but it makes them much wiser overseas, and they're starting to get a little bit of traction. The UK, they're doing quite well. They've got something in China which is growing very fast off a low base, but that's got massive potential. Ping An, yeah.
Ping An.
But
they've still got exposure to what many deem as the highest growth market globally.
And what's clever? They've got mature operations, things that are taking off, and then seeds for the future. And that's really the way you have to grow. You need that kind of mix of businesses in different stages of maturity, and they understand that. So there's very big development costs in that, but as those unwind and start growing, the growth comes through. So it's been very successful growing over the years.
I'm not letting you go anywhere until you give me your thoughts on Europe and how you expect that to unwind. I use the word unwind liberally there, and what impact that's going to have on South Africa.
Listen, it just seems the markets have come off already quite a lot, and I don't really know what the solution is there, but what I think is a new consensus is arriving is that you can't really, your austerity is not going to be the solution because you can't contract your way to prosperity. The only way is really to grow somehow to prosperity. And this is, I think, the Germans, they're not really suffering because their economy is growing, but the Italians, the French, the Spanish really aren't in the same boat. So I think that...
Well, surely the question then is, are the Germans going to continue bailing out the rest of the Eurozone?
I think they really... I think Greece is... I think everyone's written it off. It's been, this kind of... It's the third year, I think, in a row that this is happening, and people are just saying, listen, okay, we've written off the money, Greece must leave. It was a mistake.
Is that priced into the market, though? Because I've got this argument that when we
Yeah.
started speaking about the US ratings downgrade, everyone was, but it's priced into the market, it's priced into the market. When it actually happened, there was still a knee-jerk reaction from the market. Don't you think if we do see, worst case scenario, 17th of June is the election date and the key date for us, if we do see Greece expelled from the Eurozone, there's going to be a knee-jerk reaction from the markets, and a significant knee-jerk reaction from the markets.
I think you're probably right, there will be some reaction, but I think it won't be that much because, after the third year, you're kind of immune and say, so what, just get out and, you do. People get used to these shocks and prepared, and I mean, anyone with exposure there must have written off
Did you
100%.
agree with Roger on that front?
No, I think there are significant risks out there that there could be contagion. There's going to be money flowing out of banks all over the place into Switzerland or Germany or whatever banks. So I think there is a very high risk unless the European Central Bank and the European government, somehow make strong announcements beforehand to contain that potential contagion. Because if Greece goes, then the next question is who next? And obviously you look at Spain.
Are strong announcements really going to cut it at this stage? Haven't we heard quite a few attempts at strong announcements?
Commitments, not just words.
It would have to be commitments.
So we will stand behind banks, we will guarantee them whatever it is. Roger,
final thought from you on this front. We're running out of time.
Yeah, listen, I think we're in for a difficult period. There could be some volatility with that. I'm just saying it won't be as extreme as last year because people expected it and they know what to expect. But I think there's no real fresh impetus coming through for the market. It's seasonally a very bad time till October, and we could see some volatility and no real upward trend for the next couple of months.